So I'm going to start this off with the 2020 market returns. So we'll kind of go through what had transpired from a return standpoint on the different markets. And so with that, let's go ahead and get started. So first thing really is a matter of a rotation in the equity markets. When you're looking at this chart, we've got our quarterly returns, and at the bottom right-hand corner, you see the key. You've got black is the benchmark. You've got green are asset classes that have tailwind returns. In other words, there was something pushing them along. And then the orange had headwind to the returns. In other words, they were really kind of fighting just to get the returns that they got. So when you're looking at the three areas here, you've got asset class strategy, which when you see this, the global equities really performed the best at about 14.8%. And where was the biggest problem from a headwind standpoint? Well, that was global bonds at 3.3. And you can see the black, the benchmark, looking at a blended portfolio of 60-40 split, that was averaging about 10.2%. When you look over at just equities, you can see the U.S. small cap in the fourth quarter really surged ahead. Prior to the fourth quarter, it was really lagging the equities market, but had a huge push in the last quarter. As you can see, it was up 31.3%. Overall, U.S. equities ended up in the fourth quarter, not a bad quarter at all, but really the least of all of them at 12.1%. And again, you can see the benchmark was up about 14.8 when you blend the different equities. And the bond side, the U.S. high yield was at 6.5%, and the U.S. government was really lagging at a negative 0.8. So you can see there was a bit of a rotation going on relative to the asset classes. Let's look at the rally that really kind of continued after the first quarter. You can see the devastation that the shutdown did overall in the equity markets. So again, the key on the bottom shows the U.S. equities, it shows international, emerging markets, U.S. bonds, international bonds, and emerging markets bonds. In the beginning, the only thing in the first quarter that really was looking good at all was the U.S. bonds. But you can see as the recovery started to take place, you can see the equities really taking off from there. But still, overall, the emerging bonds didn't do bad year to date, and nor did the international. And the U.S. bonds came right in there as well overall year to date. So most of you, as you look at your portfolios, are seeing that the markets really were not bad to us in 2020. However, sure looked scary for a while there, didn't it? Now, let's look at the technology and how it held up. It seems that it did the best overall, benefiting all the different growth assets. So you've got this broken down into two charts, the Q4 and year to date. And you can see in Q4, energy took off dramatically, but year to date, it was kind of on the downside. You look at the S&P going down to the middle there, was up about 12.1% for the quarter, but still ended up 18.4 for the year. So it was quite well. Technology, the same thing, around 11.8 in the quarter, but the year was up 43, almost 44%. So it was a dynamic year to say the least. On the other side, you're looking at the asset classes, small cap, mid cap, large cap. You can see in Q4, again, small cap did well. Year to date, it was up 11.3, but the real winner was large cap, up 18.4 for the year. Now, you can drop down to the very bottom. You can see the large cap growth was really the big push for large cap stocks and it was up 33.5%. So, you never know which asset class is going to do the best, but you want to stay diversified. But you are going to get those big outliers that really push your portfolio, and that's what we're looking for with our institutional money managers and the way they develop their portfolios. Let's look at the U.S. credit and lower quality bonds. You can see in the fourth quarter, the short-term treasury, intermediate, long-term treasury, okay. But when you look at the investment grade, high yield, and the loans, they did a bit better. You go to year to date, and really the big outlier there is the long treasuries, up 17.7. So the bond market, as you've all heard us say, is in a secular bear market. But what does that mean? Well, it means that you're going to get kind of a W effect in the bond market. You'll have times when there will be bulls, it's going up. You'll have time when there are bears, and it is going down throughout this. But effectively, the bond market long-term will end up walking sideways, very much like the S&P did from 2000 to 2015. Let's go into the next area. Do you have any thoughts on the returns from last year, Rocky?
It was an amazing year. Who would have thought in March we would be looking at any upside to this market? We were looking at going into a recession at minimum.
Yes.
But, that turned around pretty quick.